Hi, everybody. We're going to get started here. Thank you for joining us. I'm Taylor Kendall. I am a consulting shareholder here at Lutz, and I've got Aimee with me, and we're here to talk about due diligence and key metrics for success. The point of this presentation is really to dive into what we do in a standard due diligence procedure, and then also hopefully give you some tactics to use as you're looking at transactions and also learn, when to get others involved. So we will get rolling here. If you guys have questions, throw them in the chat. We recognize that there's a lot of different folks online, so wanting to make sure this is providing value to you. So if you have questions, we'd love to just address those versus, just running through the presentation. So with that being said, we'll get started here. As I mentioned, here's the agenda for what we're going to discuss. We're primarily focused on financial due diligence, although we recognize there's a lot more to due diligence in a transaction than just the financial aspect, but that's obviously our bread and butter. So we'll then eventually get to, how do you respond to risks when you're looking at a transaction, and then post due diligence, what happens then, and how can you use the findings within your due diligence process to help make the transaction run smoothly and the integration effective. So with that, I'll pass it off to Aimee to go through our first section here.
All right, thanks, Taylor. Hello, everybody. So we are going to dive into the financial due diligence section. So this slide here just kind of takes us back to a high level of what a transaction process typically looks like. Either if you're a buyer or seller, you find your, matching party. Typically, there's some financial information exchanged back and forth. You're having some management meetings. You agree on an offer. Everyone's pretty excited. You sign an LOI. And then a lot of times we have clients come to us and say, hey, we're about done with this. Can you help us seal the deal? And it's like, oh, no, you're just getting started. So I think it's just we kind of laugh, but it's just a reminder to everybody that the due diligence process is probably everyone's least favorite process in a transaction, and it's probably one of the most time-consuming processes. So just kind of a reminder of, hey, once we get to that LOI stage, that's really when, we're exclusively dating somebody at that point. We're not talking to anybody else. And that's when we're, all of the financial information that has been provided up to that point, now we're going to dive in and they're going to say, okay, prove that this financial information is actually accurate so that the value that we've agreed upon, we can actually sign the final purchase documents.
And that's a really, just interesting look when you think about it, that, a lot of times buyers have made an offer, before they really got into the details of the numbers and that due diligence phase. So really, our hope in the due diligence phase is to really validate that offer and make sure that it's right. Our slide says, now prove it. It's okay, we've made this offer, assuming that what you've presented is accurate. Now let's really take the time to dive into that and make sure that's true.
Yep, absolutely. And, most times your LOI is going to state something of, hey, this is contingent upon the completion of due diligence, most often by a third party. Sometimes people are doing it internally, but you're not going to get to that, final end goal without completing that due diligence process. So here, Taylor and I's primary job is to look at financial due diligence, but we also just want to recognize that there's a lot more that goes into the due diligence process than just financial due diligence. So, we're often preparing quality of earnings or, maybe a more tailored version of due diligence. We've got an awesome tax team here that can do tax due diligence, but, you've got your attorneys involved to do the legal due diligence, a lot of HR due diligence involved, and then I think we've got another few more. Yep, you've got a lot of technology due diligence, and then sales and customers might seem a little odd on here, but a lot of times, at least we would recommend if we're consulting a seller, not to provide information on your customers or vendors up until you get to that LOI stage. We consider that confidential information. So once that information is shared, it's important to look over these customers and vendors, and we talk a lot about concentrations, but also if you get a hold of this customer listing and you're buying a company and one of these customers is one of your biggest competitors, well, is there a risk that upon closing this transaction, is this customer going to walk away because they see this as a risk to do business with you? So just some things to consider outside of just actually taking and tying the financial information.
That's, really the psychology of the transaction that we like to get into is, even if everything looks good on paper and we tie everything down, if, the cultures don't align of the buyer and the seller, or, as Aimee mentioned, there's a competitor that's a major customer, something where the deal just doesn't make sense, we want to make sure all those issues are, flushed out in the process so that you're not getting later down the line and wondering, why you're doing this deal.
Definitely. Okay, so what are your options when it comes to financial due diligence? It's not a one size fits all. There's different risks on all different transactions. Everyone's budget's a little bit different. And so we always say, hey, talk to us, let us review the financial statements, and we'll help come up with a tailored due diligence process that can meet your budget, but also help, get you more comfort on the potential risks of the business. I think Taylor and I always advise people, we strongly feel that at least some form of due diligence should be done on any transaction. Doesn't necessarily mean you have to get a full formal quality of earnings. And a lot of times, depending on who the user of the final due diligence report is, we'll tell our clients, hey, it's really not necessary. We think we can get you comfort by doing, maybe a workbook format or just focusing on these risk areas. But at the end of the day, we strongly stress to our clients that they should do some form of due diligence before closing on a transaction.
And really, some of the other points that, Aimee has up here is just figuring out, how clean is the information. I think, we can figure out pretty quick if we think it's a complete disaster or if things are pretty clean just by doing a, 2-hour to 4-hour half day, run through of their QuickBooks file. So I think even if it's a small transaction, if you're spending $1 million to buy something, I think it's worth the extra cost to, pay an expert that's in this day in and day out to figure out if those numbers seem at least reasonable. So, our deal size really ranges from small deals in that $1 million to we've done reports on, $120 million purchase price. So it's all across the board, but regardless of size, we think there's some key, items to do on every transaction that we should focus on.
Definitely. And I think we'll get into this a little bit more down the road, but, even if they get an audit at year end done, a lot of times we're not just looking at a clean year end. If we're rolling forward to a trailing 12 months where there's not clean audited financial information, all of a sudden we're not looking at strong GAAP financials. So a lot of times people will say, oh, they get an audit, so their financials are good. And that's not necessarily true if there's differences in their monthly, quarterly, and year-end procedure. So we still recommend doing some form of due diligence just to know what you're getting into. So this slide just kind of runs through some of the common due diligence issues that we run into. Buyers, some of the key things that they're looking at are profitability, growth, and size. So, you're going to give somebody your historical financial statements and maybe it's showing huge revenue growth or huge growth in margins. And ultimately the due diligence process is going to prove out, hey, do we really think this is sustainable? And can we really say why this growth is happening? Like we said, the reported financials, if they've given us a bunch of EBITDA adjustments and add backs, we're going to validate those as well as, tie down the balance sheet, do a flux analysis on the income statement. Again, we talk about customer and vendor concentrations. We're going to look at these listings and see if there's a risk there. Management team, a lot of times you've got, a founder of a company that kind of waits until they're ready to retire and says, hey, I want to sell my business. And when I sell it, I want to be done. Well, that's considered a risk to a buyer, because if you've built this great business and all of a sudden you want to walk away day one once the transaction is closed, well, who's going to be that strength, that strong management team to continue the ship moving forward? And also other key employees, sometimes it makes key employees a little skittish when they hear that there's going to be a transaction involved. So it's putting key agreements or things in place to make them comfortable that, hey, I do want to continue with this post-transaction. All this to be said, we feel that there's a lot that can be done prior to due diligence. On the call, if you're a potential seller down the road, we think there's a lot that can be done to help prepare your business to be sold and kind of eliminate some of these issues that we find during due diligence. All right, I'm going to pass it back to Taylor to just kind of run through our high-level processes.
So up here on the screen, we really have, what does it look like if you were to hire, Lutz and Aimee and I to do a process for you. So really we're determining the scope on the front end. We're basically getting a gauge of, what do you see as the risks of this business and how can we tailor our procedures to, what you're most worried about. Then we're going to, kick off calls with the necessary parties, start to get to know the seller a little bit more, and then really dig into the details. We're going to perform analysis over the financials. We're going to, provide questions to the management team, and really we're spending probably 2 to 3 days really hard pressing management to answer our questions. I mean, a lot of it is, back and forth where we don't really know what the risks are until we get into the project and we start asking questions to a client of, walk us through your revenue stream. How does a customer place an order? How do you deliver the order? And then finally, how do you collect the cash? And how does all of that flow through your accounting system? As we start understanding the processes, we start determining, here are really the places that something could go wrong in the process and potentially, create an EBITDA number that might be incorrect. And a lot of times you're basing your purchase price off of that incorrect EBITDA number. So again, as you can see up here, the weeks that this generally takes, we know that most sellers have obviously never gone through a process. They've built their business and it's really their livelihood. So a lot of times they get an LOI and think, well, now, I'm out of the work here. Well, the work really has just begun, and we're going to spend, 4 to 6 weeks really hammering their financials and metrics and all of that, and really completing that due diligence process. So, Aimee and I have joked that we've gone to different clients and, they say, hey, I really like you guys, but you're kind of like my dentist in that, I don't mind seeing you, but I'm glad to not see you ever again or for the next 6 months, right? So I think that just goes to show we recognize that it's not an easy process, and we know there's a lot more to it than the financial aspect, but we think that digging into this and, perhaps providing somebody's lifetime return on their business is warranted to really dig into this information. So this just goes through our process and really how we get from start to finish.
Yeah, and I think the only thing I'll add on that is a lot of times people ask, how quickly can you get this done? And, a lot of it is dependent on the quality of information that we get and also the availability of management. If there's, weak gaps in getting responses from management, or we're getting, hard copies of financial statements that we're having to scan in and things like that, it's going to take a lot longer than if we can get access to a QuickBooks file and management's readily available to answer our questions.
So then up here, I have just some of the things that we consider right out of the gate. I mentioned understanding processes from start to finish. Along with that goes systems. If we quickly figure out that the inventory management system is not very robust and maybe the target is just adjusting inventory values through a journal entry once a month, well, that's going to create more risk, and that's going to be harder for us to integrate that business on a go-forward basis. So again, we know risks are going to happen. We just want to understand what those risks are on the front end. We're also looking at, what is the month-end close process? Does it seem like, the management team is developing a thorough review of their financials on a monthly basis, or is there a lot of that that's just occurring annually? And that matters because we'll look at monthly P&Ls and monthly balance sheets for a lot of targets, and we're using that to identify outliers or trends in the business. And if a client doesn't close their books on a monthly basis completely, then there's going to be some significant swings throughout the year which makes it difficult to peg working capital or, figure out really what their normalized earning stream is. So identifying those differences between annual close and monthly close can really help us, more easily get to EBITDA adjustments that we need to record in order to have a good number that LOI is based upon. We'll also look at, how does the business look at themselves on a monthly basis? What are the major KPIs that they're using? We find that's a really easy way to know what we should be paying attention to. This is the reports I look at. Well, how does that flow into the financials? And how does that, help us make decisions? Another area up here is cash versus accrual. If you've got a cash basis financial, it's really difficult to, prove that that's sustainable and that it's fair because your revenues and your expenses aren't necessarily matched. So if you're going to pay a purchase price on a cash basis EBITDA, all day long, we would say that is not a good idea. And you should be able to do some, procedures to get it to a semi-accrual basis. So you have a better sense of true margins and true, EBITDA margins as well. I mean, the big thing there is just making sure you have consistency across the periods that you're presenting. If 1 year is cash basis and 1 year is accrual, you can't really compare the two. So I think looking at things consistently, pushing the customer, the target to have accrual-based financial statements are the two main keys that we see. Lastly on the slide is the budgeting process. I think seeing how a company budgets helps know how in tune with the business they are. We look at some targets that have no budgeting process, which makes us kind of question their ability to dig into their historical financials as well. And I don't know if we've mentioned this yet, but as a frame of reference, we generally look at 3 to 5 years of financial statements to really complete this analysis. A lot of our work is on the trailing 12 months, but the last 3 years is our standard, and in some cases, going back 5 years just to get that trending analysis is important.
So we have a question that says, how often do you find the seller CPA firm is answering many of your questions? Does that concern you? Do you prefer answers come directly from management? I would say it kind of depends. A lot of times we are working with the seller CPA, but I think oftentimes what we find is that, the seller assumes that the CPA knows more than they do. And I say that because a lot of times if they don't have assurance work performed, then they're just doing, year-end tax returns and maybe some adjustments at year-end to get prepared for taxes. And so then we're asking a lot of, monthly close procedures and quarterly close and things like that. And so a lot of times there's a disconnect of the seller thinking that the CPA is going to know the answer and they don't. But I would say it doesn't concern us as long as the CPA isn't fully directing the financial statements, but, management has to take ownership of the financial process. But anymore, there's also consideration too of, is there outsourced accounting involved and things like that. But at the end of the day, someone in-house should be taking ownership for, the financial processes.
I think it always comes back to deal size too. I mean, we see several small businesses where, someone internally is tracking their QuickBooks file and really doesn't have a lot of accounting experience. I don't think that would prevent a buyer from purchasing them because they understand when you're buying a small business, that's just the name of the game. But I think as you start increasing in size and value, you start saying, hey, you're a big enough target that you should have a controller or a CFO internally that's able to take responsibility.
Let us know if that doesn't answer your question.
So now we're going to just dig into the income statement and the balance sheet and what we're really looking at as CPAs trying to help the due diligence process move forward. The income statement, I think, is the main statement that most people think about when you think about due diligence or valuing a business. You're trying to get to that cash flow EBITDA number. So how do you get there? You know, you're going to look at all lines of the income statement and dig in deeply there. So we always start with revenue. You know, is there revenue recognition policies in accordance with GAAP? Do they recognize revenue in a way that matches revenue to expenses? If they're not following, you know, GAAP policies, what does that mean to the numbers, and how can that be adjusted so that we can get to a GAAP basis number? We're also always going to perform a revenue proof. Basically, that just means we're going to reconcile revenue per their financial statements to cash deposits per the bank statement. Obviously, recognizing that any changes in their AR balance year over year will have to be normalized out of there. But I think this is a great test just if you're trying to kick the tires on a client and, you know, you get a financial statement, it says $5 million of revenue. If their deposits in the bank, you know, excluding transfers and all of that, are about 5 million, I feel pretty good about revenue, at least at a high level. I mean, I think that's a good gut check for me. So we're always doing that in our process. We also want to understand pricing and billing to figure out, you know, how are we developing our pricing? Have we recently included a price increase to our customers that perhaps we're going to lose clients from? Have we not done a price increase for several years and we should consider doing one? Understanding those policies and how we're really reaching the pricing that we're offering to our customers can provide a lot of insight into our revenue streams. Just trending revenue in general, I mentioned looking at 3 to 5 years of information. What has revenue done over that period and how can I explain it? Can I say that it's a specific customer? Is it a specific sector of our business? If one sector of our business is improving, but that's a lower margin business line that we're in, well, is that really what we want to see? Whereas maybe the higher margin business line is actually declining. So really digging into the details here to understand that trend in revenue and make sure the client can support it and articulate those changes. Aimee had mentioned previously about customer concentrations. This is a huge one. If you have a revenue from 3 customers that makes up 90% of your revenue, there's a lot more risk there, and the valuation should be discounted accordingly because it's very possible that that customer could leave when the current owner is no longer there. So what goes into that is analyzing contracts. Are we in long-term contracts with our customers where they're going to have to stay even if a transaction occurs? Or are these, you know, annual contracts that we don't really have a good gauge on whether that customer that accounts for 50% of our revenue is really going to continue on a go-forward basis?
And I think the one thing I'll say on the revenue trends is, you know, when we say that we're looking at 3 to 5 years, you know, depending on what the economy's done, which we all know in the last 5 years, there's been some crazy, you know, fluctuations in commodity prices and things like that. So when we're looking at revenue trends, you know, we have to understand, depending on what the industry is it an increase because of volume, or is it an increase because of some crazy changes in prices that maybe isn't normal and sustainable going forward? And we've seen a lot of that in the last few years of having to normalize financial statements for abnormal years that we're looking at. So just wanted to touch on that, you know, ensuring that the business is actually growing and not just seeing, you know, inflation in prices.
Once we've validated revenue, we move down the P&L and discuss margin and other expense analytics. Again, we're going to trend margin year over year on those periods presented and have management really explain the fluctuations that we're seeing. We might even dig into margin from, you know, individual SKUs or service lines so that we get more information on what parts of the business are growing, what parts are really providing that bottom line cash flow, and how can we drill into those areas since that's really where the value remains. With cost of goods sold, we're also going to consider how our overhead costs and other costs allocated to cost of goods sold. Is that allocation reasonable? This gets into inventory costing a little bit if you're in a product-based business. And getting a handle on that is key because that can cause some very significant fluctuations in margin, and making sure those margins are sustainable post-transaction is key. We talked a little bit about a revenue proof previously, from, validating deposits per the bank statement to revenue per the income statement. We're going to do the same thing on the expense side, get the bank dump of all the transactions for the year and ensure that the expenses or withdrawals per the bank statement match the expenses per the income statement. Obviously, there's several things we have to normalize out of there, including, purchases of fixed assets, transfers between bank accounts, etc. However, this too provides a high level overview of, hey, these margins seem reasonable. Cash is going down and up by the revenue and expense per the bank statements each year. Lastly, we'll dive into operating expenses. Depending on the business, most people know what a fixed spend might be. So in those cases, we might focus more on margin and cost of goods sold. This just goes into what's important to the buyer. If we've got a strategic buyer that knows the business and they know the overhead that it's going to take to make that business run, we probably don't care as much about operating expenses, and we're just going to hammer that margin a little bit harder. Whereas if it's a service-based business and you really just have revenue and operating costs, we're probably going to dig into those operating costs a lot more. A few of the things we could do would be a payroll proof, where we're getting the year-to-date payroll register and making sure that, wages per the payroll register match, salaries expense per the P&L. That's just, again, another easy test to validate a large number of the income statement. Some of those other accounts that we'll dig into further are just ones that we know have potential for needing to be normalized. For example, bonus programs. If we're paying bonuses to related parties that really aren't in the day-to-day business, well, we should probably normalize those out of the P&L. Professional fees, there might have been some one-time legal issues that the company worked through. One, we want to know of those legal issues, if they're a legal issue we could be taking on. And two, we want to know if we need to normalize those professional fees out of the trailing 12 months that we're analyzing. The last one up there is rent expense. We see a lot of companies that rent from a related party. So ensuring that that rent expense is fair market value is important, so that the buyer knows, here's what I'm paying for on a go-forward basis. We've kind of talked about this throughout, but the point of our due diligence is to ensure that that EBITDA that's been presented to us is accurate. So we want to normalize that number for any, salaries expense that aren't normal or aren't at fair market value, rent expense, those type of things. So what we normally see is that management of a target provides their suggestion of adjustments, which are normally aggressive because they're trying to, inflate their EBITDA. So they're going to provide those adjustments. Then we're going to come in and say, hey, those are either right or wrong, and we're going to adjust those for due diligence adjustments. And then the third type is a pro forma adjustment, where we're considering potential synergies or other cost savings that might happen on a go-forward basis. And really, it should be, noted that those, yes, you should consider pro forma adjustments, but when you're determining what you should pay for a business, you should pay for the business as it currently stands. Maybe you're going to increase the multiple you're willing to pay because there's tremendous upside on the synergy side. But in most cases, those are future looking, not historical, and we wouldn't normally include those in our normalized EBITDA that we're presenting. Other considerations, we'll get into these as well, but these would be non-calculated items where we know there's a potential risk here, but it's not possible for us to calculate the actual adjustment to normalize EBITDA. So this is where we get into, what's the risk tolerance of the buyer? we can say, here's what we think the potential risks are. We can't quantify it. So how are you going to use that information to potentially change your deal or, get to a different number? So here we've presented some common EBITDA adjustments. I mentioned some of these previously. Owner salary is a big one. We're always going to hone in on that and make sure that, are they being paid market value for what they're doing as the CEO of a business of this size. Other owner related expenses, some business owners are running significant personal expenses through their business. What's really personal and what's business might be difficult to determine, but that's what we're trying to do. Some sellers might say, hey, all of this advertising is really personal expenses. Well, they might say that, but that might not be true, because if we're not entertaining our customers or doing some of this stuff, we're not going to maintain those customers. So there's a lot of judgment involved in that, but I mean, these are some of the common ones that we see on a day-to-day basis.
Yeah, and I think the only thing I'll add here is on the personal expenses, we'll help sellers put together, management EBITDA schedule sometimes. And I call it, people tend to get add back happy. So they hear that if you have personal expenses in your income statement, then we add them back, it increases your value. So just going back to one of our first slides where it says due diligence, now prove it. We have to make sure that, one, we can support those personal expenses running through the income statement, where if you just provide, a lump sum number, but the due diligence team can't go back and trace those through your income statement, then it's less likely than they're going to give you the value for those add backs. And another thing that I run into a lot is people will provide me with, items that run through distributions, or maybe items that are capitalized to fixed assets. So the only add backs that we can allow are things that have ran through the income statement, and not things that have been capitalized on the balance sheet or ran through distributions.
I mentioned pro forma adjustments before, and this is really trying to reflect EBITDA based on this future state of the business. So if a strategic buyer is looking at a target and they already have their own, IT and accounting infrastructure, likely those positions at the target could be eliminated. But again, we're going to note those as pro forma adjustments, but not really impact the value that significantly by those known synergies. Other considerations is accrual and GAAP accounting. If they're really not following GAAP accounting, it's probably going to be pretty impossible for us to get to that point on what true EBITDA should be. And so we just need to note that, personal expenses, we can dig as far as we can into the details, but we don't always know if we have all of those captured. CFO and accounting staff, what's their talent level? Do they know what they're doing? Do we have the right management staff, et cetera? And then also just CapEx trends. A lot of people are so focused on EBITDA, which is, makes sense. But at the same time, if a business is very capital intensive, they need to consider those CapEx trends that have happened historically and what we would expect to happen in future years as well. So at the end of the day, with the income statement, our goal is to get to an adjusted EBITDA number that we believe can be substantiated through support. So we've got a polling question here if you guys are here to get CPE. So we'll give you a minute there.
All right, we're gonna go ahead and keep moving. So now that Taylor's talked about the income statement and getting to adjusted EBITDA, I'm going to talk about some of the procedures that we do on the balance sheet. So first things first, I think the biggest thing is don't forget the balance sheet. A lot of times we will have people send us financial statements and they'll say, hey, can you look through these and kind of let me know what you think high level on value or what the risks are? And all we get is historical income statements. No one ever considers the balance sheet. And, what we say is, hey, you can't get comfortable with an income, 12 months of an income statement if you don't know what the goalposts are surrounding that income statement. So, if AR is wrong, then that means your income statement's wrong. If inventory is wrong, that means your income statement's wrong. So we have to make sure that we're analyzing the balance sheet along with the income statement. And a lot of times our first approach is, at the bare minimum, at least tie down the balance sheet at 2 points in time, because if you can get comfortable with the balance sheet as of December 31st this year and December 31st last year, then you can at least feel decent that your income and expenses are all running through your income statement. So some of the things that we'll do, we'll do a fluctuation analysis on the balance sheet. And really what this tells you is if you're seeing significant swings on your balance sheet year over year or month to month, okay, do we have maybe some customer payment issues? Maybe our AR is getting aged. Maybe we're not, we don't have good purchasing processes over inventory and we're carrying too much inventory on hand. Are we not able to pay our bills? And so our accounts payable is increasing. So that's part of our fluctuation analysis. Like we said, at the bare minimum, we always suggest at least tying down, the major balance sheet account balances. And then we also talk about payment terms for your customers and vendors. And the reason we do this is if we have, a seller tell us, hey, our typical customer payment terms are around 30 days, and then we ask to see the AR aging and we see most of the accounts receivable balances aged past 90 days, well, that tells us that we have some collection issues. Same on the vendor side. Maybe they'll tell us that, hey, we typically are prepaying our vendors, but then we're not seeing any deposits for our vendors, things like that. It's a good indication of whether true GAAP financials are being followed, because a lot of times people think, hey, because I've got accounts receivable and and accounts payable out there, then my financials are on a GAAP basis, and that's not necessarily true. Like Taylor said, PP&E, we add back depreciation for purposes of calculating EBITDA, but if it's an asset intensive company or industry, then we want to know what those future capital expenditures are, as well as historical capital expenditures. Inventory, I think Taylor and I would agree that typically if there's inventory on the balance sheet, we normally find something. A lot of times people aren't tracking maybe obsolete inventory correctly, or they're not costing inventory properly. If they're on kind of a modified cash and accrual basis, then a lot of times some inventory is getting put on the balance sheet, while other maybe component inventory is getting ran through the income statement at the point of purchase. So it's really hard to track good margins. So I think we would always say, hey, if you're looking at a company that has inventory, you should always, kick the tires a little bit around this. What are your count procedures? Are we doing a full physical inventory count at year end? Ideally that would be the bare minimum, but we'd also like to see at least some cycle counts done monthly or quarterly to make sure that our inventory balances are accurate. I think for key financial metrics, if you can track your, AR turnover, AP turnover, and inventory turnover, then that's a good indication of, hey, how quickly can I convert my cash to a sale and into profit, which if you don't have good GAAP financials, those aren't always, we can't always actually calculate those. But if someone tells us, hey, I typically turn my inventory every 90 days, but then we look at a balance sheet and you've got $1 million of inventory on your balance sheet and $500,000 in cost of sales on your income statement, well, that tells me that $1 million should be 2 years worth of inventory, right? Because you're going to cost $500,000 one year and $500,000 the next year. So that doesn't really align with what you're telling me of how quickly your inventory turns. So then we're going to dive in and say, hey, do we have really aged inventory? Can all of this actually be sold, or do we need to write it off? And ultimately, this is all going to turn into helping you come up with an accurate working capital calculation as well.
Really, if just as an example, if your inventory balance is off by $200,000 because we started some new software in the current year and started costing differently, and we don't really know what we're doing, but it's applying some standard rate to inventory that maybe is not accurate. And we find out inventory is overstated by 200,000, and you were planning on paying a 5 times multiple of EBITDA, that's going to adjust your purchase price potentially by $1 million. So I think it just goes back to Aimee's original point on the balance sheet of ensuring this is correct is really how you make sure that the income statement is correct as well.
Absolutely. And then the last one here is just accrued liabilities. You know, we're always going to run through the balance sheet and see what is there, but then we're also going to ask the question, hey, what's missing? So, you know, your standard accruals for, you know, payroll, vacation, PTO, things like that. But then also we're going to ask about, you know, are you guys self-insured? Is there a reserve out there? You know, when we're talking about customer payment terms, then all of a sudden we realize that, hey, our customers are paying us up front, but there's no deferred revenue booked. Well, then that tells us that we're recognizing that revenue prematurely before we've actually earned it and perform that service. So that's also a big part of our procedures, is not only verifying what's on the balance sheet, but also trying to figure out what's not on the balance sheet but should be. Okay, so we're going to run through working capital very high level. I think we'd need a whole nother webinar to do this at a detailed level, but I would say most transactions have some sort of net working capital target that gets set, and it's something that, you know, is always negotiated. I think a lot of people don't understand it, and then it seems to be one of the final things too that kind of tends to hold up a deal. So what is working capital? Just from a standard accounting definition, it's your current assets less your current liabilities. Now, in an M&A transaction, typically your net working capital is calculated as current assets less current liabilities, but it excludes your cash and it excludes your debt balance. So it is a little bit different when we're looking at it in an M&A transaction. And really, when you think about it, you know, your current assets and current liabilities are what you need to operate your business. So if you're going to go buy, you know, say a retail store, and on day one, all of a sudden your seller stripped you of all of your inventory and you have no inventory to sell, well, why wouldn't you just go start up your own business, right? So part of buying a business that's already up and running is getting that working capital that comes along with it. So day one, you can keep the business operated and not having to inject, you know, cash to go buy a bunch of inventory and things like that. So common questions that we get on net working capital targets. I think the number one is, do I get to keep my cash and my AR at the end of transaction? Because people think, hey, I did the work to earn that cash and I did the work to earn that AR, so I should get to keep all of that at the end of the transaction. So the answer for your cash is yes. Typically, you're going to keep your cash post-transaction, but no, you are not going to keep your AR post-transaction. That goes back to what we just talked about of, hey, you've got to leave your buyer with some working capital to continue running this business going forward. Now, this answer could change if you've got deferred revenue and you've collected cash up front for services that still need to be performed for your customers. So then often it's negotiated of, hey, you're either going to keep a little bit of cash in the business to help them fulfill that service, or there might be an adjustment to the purchase price to make up for that cash that you're taking out for the services that still need to be performed. What's the point of a net working capital target? Like I said, you know, if you're going to go buy a business and all of a sudden on day one, the seller stripped you of all of your inventory and all of your AR, so you're not collecting cash to purchase more inventory and you have no inventory to sell, but they left you with the payables balance and you're having to pay all of these bills for, you know, the inventory that you weren't left with. So the point is so a seller can't manipulate the working capital up to close and, you know, leave the buyer in a bad situation. So the target is set off of a historical average of what normalized net working capital has been. So then, you know, there's a fair amount of working capital left in the business post-close. It's really not supposed to be a win or lose situation for a buyer or seller. It's supposed to be something that's fair to everybody, but, you know, the quality of the financials that this net working capital target is being set off of can be incorrect and cause for somebody to win or lose, and that's what we try to avoid. So how is the net working capital target calculated? Typically, it's off of the trailing 12 months historical average. Now, depending on seasonality of the business, maybe growth of the business, and also if we learn, okay, our monthly GAAP financials kept, or is it maybe done on a quarterly basis, annual basis? There's things that we need to look into to make sure that the correct target is being set. There are times that GAAP financials just are not prepared at all. And sometimes we're able to adjust these to full GAAP financials and sometimes we're not. And so then, there's some alternatives being discussed of, hey, what can we do, to replace the net working capital target? And then how can I ensure a fair net working capital target is set? We would say include an advisor to help you negotiate it as well as calculate it. As a seller, make sure your receivables and inventory and payable are staying current and turning. If you as a business owner are having to continue to, purchase more inventory and keep more receivables on hand because it's not turning enough, because if they're not turning, then a seller is going to say, well, you need to leave me more in the business because your receivables aren't converting to cash quick enough. Your inventory isn't converting to a sale quick enough. So I need something to help pay all of these payables in order to continue operating this business. So making sure that you're managing your inventory levels and things like that on a historical basis is going to make sure that a fair net working capital target is set. Oftentimes maybe business owners like to keep additional inventory on hand, even though they don't have to, just because they have the cash to do it. Well, if you think about it, then historically, you're going to have an above average inventory balance than what you really need. And at the end of the day, that's going to mean that you're going to have to leave more inventory back for your buyer and you're going to have less cash in your pocket post transaction. So that's a very confusing topic. We're not going to get into any more detail on it, but if there's questions, definitely let us know. But I think at the end of the day, this always comes up in transactions, and more times than not, if someone's selling their business, they've never sold a business before, so they've never had to come up with something like this. So we highly recommend including an advisor and talking about it early on in the transaction rather than waiting until the very end. Okay, other considerations. So how to respond to risk, it's different for everybody. I mean, everyone's risk tolerance and appetite for risk is different. The experience level that they have in the industry and type of business that they're looking at buying is different. The findings that we have in due diligence, we present them to the buyer, and typically, there might be an adjustment in a purchase price. Maybe there's, hey, we said that we were going to pay you up front, but actually now we're going to give you, if we're going to pay you if they initially offered you a 5 multiple, now maybe it's a 4 multiple with the opportunity to earn an additional multiple with an earn-out agreement. Things like that, and like we said, it varies. I don't know if you've got anything to add on that, Taylor, but it's really not a one size fits all.
Yeah, I think it is your risk tolerance, because we might say, hey, we can't get comfortable with this target's inventory. Like, there's no way to do it efficiently without spending tons of money to get it right. If you're pretty confident that you think the revenue stream is there and you can capitalize on it, maybe you're okay that we can't dig into it as much as we would prefer to. So that's really why it does go back to the risk tolerance, and you can lower your risk by doing some of the things Aimee's suggesting here, adjusting for an earn-out, locking in some of the other guarantees, signing up for employment agreements, those kind of things, so you have some continuity in management. There's a way to respond to the risks, but you're not going to address all the risks. So you've got to figure out what is your risk tolerance level.
Yeah, and we're typically working with, small, lower middle market companies. So when we go into the due diligence process, or if we're helping somebody sell their company, we're not expecting it to be perfect. There's always going to be findings. And as a buyer, I think they know that as well, that small businesses are not going to be on full GAAP financial basis and things like that. So I think it's important, just to know the company and feel like you have that comfort level of, okay, what risk am I able to take on going forward? And worst case scenario, what's this do to my return on investment? So post due diligence action plan, we provide you guys a deliverable of all of our findings, and, maybe you guys assessed your risk and there was an adjustment to the purchase price, maybe an earn out was added, things like that. But then there's also going to be findings that, you know, as Taylor talked about, maybe it's a non-calculated finding that we weren't able to actually quantify it, but we told you that, hey, here's the issue. Or we found out that, you know, there's issues with the inventory system or, you know, the CRM system, things like that. And how are you going to address this post due diligence? Because, you know, that might be more of a pain point than really just coming up with the valuation. And so we always encourage the buyers to consider, you know, just because this might not change the value of what you're willing to pay for this business, you know, what are the pain points that you're going to experience to actually get this company integrated into, you know, your platform or whatever the plan is. And a lot of times I say, you know, what's the long-term plan for this and what's your holding period? Because if you're, you know, your hope is to hold this business for, you know, 5 to 7 years and then turn it around and sell it again. Well, if it's going to take you 2 years just to get this company integrated and up and running and their processes changes and improved, well, are you really going to maximize your value within that 5 to 7 time frame? So just things to think about that, you know, I think everyone's thinking of a dollar figure up front during due diligence, but it's also of how seamlessly can you integrate this company post transaction.
We found that if you do more thorough due diligence, it makes the integration process a lot simpler because you know what you're getting into, you know the pain points and processes that you're going to have to improve right out of the gate, and you can hit the ground running versus closing the deal and then having to go dig into all those processes. I think hiring an advisor like us to do some of that digging in and provide you with a deliverable that you can refer back to say, hey, here's these 10 findings that I need to look into. Here's how their contracts are structured. Here's the, you know, benefits that they're currently offering their employees. It's sort of a playbook that you can use to continue on with integration, which is why we think it's warranted on any transaction.
Absolutely. Helps avoid surprises down the road post-close that maybe you weren't aware of prior to closing on the transaction.
Yep. Yeah, with that, we'll open it up for any questions. Happy to help any way we can here for you guys. All righty. Thanks everybody for coming, and reach out if you have any further questions. We appreciate your time.
Thanks everyone.